everyone, I trust that you're well. My name is Wango Muriuki. I'm a social media manager, content creator, and digital marketer. Welcome to another episode on financial wellness. Today we'll be talking stock exchange, and I'd like to say a big thank you to everyone who subscribed, gave us feedback. Please, if you haven't subscribe and click on the post notification bell to be alerted every time a new episode is up. And today, for the first time on this financial wellness series, we have a gentleman. I'll allow him introduce himself and we'll dive right into the topic on stock exchange.
Hi everyone, my name is Felix Ocheng. I'm an investment banker with 4 years experience in investment banking. I'm also a trader. I deal with stocks on the Nairobi Securities Exchange, and I'm glad to be here with you guys today.
Okay, sawa. So we'll start with the most basic thing. What exactly is stock exchange?
So the stock market, basically, what most people would refer as the stock exchange, is a market where people buy shares of companies.
Yeah.
If you've probably been in a chama, or if you probably held business with a friend, you always hear people saying, I need my share.
Yeah.
So in the stock market, what we do basically involves us now trading on publicly listed entities, and then we trade on their shares.
Okay.
So a share is basically a unit of ownership, and now the stock market involves where individuals trade on these units of ownership of companies.
Okay. And so how do I determine where to invest and how much to risk?
The moment you get into the market, there is every company has its own risk aspect, and so the moment at a point when you start investing, you need to understand your risk appetite as an individual. Some companies have a lot of volatility, and that means a higher leverage on the company.
Yeah.
So that would basically mean if you're investing, you expose yourself to a lot of risk. On the other hand, we have companies that have what we call fundamental aspect. And so as an individual, at any point when you're picking on a company that has stronger fundamental aspect, then you know that you're selecting companies that have broader growth and broader view for them to get into. So just to answer your question on how much you need to leverage and how to know a company that you're selecting on, companies have different business models, they have different fundamentals. So it's basically you as an individual understanding the company first before you select it. I know there are a lot of things that would affect a few individuals, like how much a share on a company would cost. We have companies that go for as low as 30 cents, and we have companies that are trading as high as 500 Kenya shillings.
Okay.
So such would be able to affect you to some extent in stock selection, but I believe all of them would come into you as an individual selecting your stock.
Okay, sawa. And is this an investment that I could leave for my future generation? That's my kids, grandkids, great grands.
Yeah, actually, when you're investing in the stock market, the famous individuals who've invested on the stock market, we have people like Warren Buffett, and there's a famous quote that Warren Buffett says, if you don't plan to hold a stock for more than 10 years, then it's almost needless buying it. Stock markets have various returns that come with them. For you to invest in the stock market, you need to be prepared. I'm not saying that now if you invest in the stock market, it will only be for 10 years and above, but you need to be in it for long term. The moment when you're investing, and whether you're investing on the stock exchange, whether you're investing in a business, you always need to plan to hold it for long term. Otherwise, if you're investing for short term, then you're leveraging on a high risk, and I don't think that is what I would advise you to look into.
And so what would you say that people need to know before getting into stock?
I think first of all, you need to understand the risk, as we've mentioned. I've been mentioning on risk a lot because most of us, mostly the younger generation, we don't understand, we don't look into risk. We would want to invest because we know there's money that is coming in after a few days, after a few weeks, or a few years, but hardly would we analyze the entire risk that is getting into the entire market and the investing process. So you need to understand a few things. An example is when you're picking in onto the exchange, you need to know if the market is on a bear run or the market is on a bull run. A bear run is basically when the market is on a downturn. And with a bear run, there are a lot of opportunities because you see, just like any business model, you need to buy low and sell high. So the same way on the stock market, when you're getting into the market, you need to understand a point where you're buying low and selling high. When the market is on a bull run, you need to be careful because if the market goes on to a point where the price is no longer sustainable, then there's likely to be a downturn or a market crash, and you probably wouldn't want to be involved in that during a bull run process.
Okay, and so while we're at the need to know basis, what would you say are the pros and cons to stock exchange?
I think one of the things that we have is that the first bit is that you might lose money in terms of value, paper value. But then there's one thing that is usually attached to you losing money on the stock market. There's one statement that we always say as investment bankers is that you have an opportunity not to lose until you sell. An example is if you buy a share today at 30 shillings and tomorrow it goes down to 20 shillings, the paper value has been eroded, the value of the share has been eroded, but the paper value is yet to be lost because you're yet to sell. You only realize a profit and a loss when you exit that counter, which basically means you're now selling onto that stock. Another thing that you need to look at too when investing is if you invest in a bad time, there's a high possibility that the price will come down. And we also have another negative effect where you find if you invest in a company and then it's suspended from trading, that means you're locked into that company until a point when the company resumes trading. We've seen guys invest in companies like Athi River Mining, Kenya Airways, and now we have Nairobi Business Ventures, which was suspended just the other day. So investors who invested in these companies have their money locked, and you don't know when these companies will resume trading. On the benefit aspect, companies usually give dividends. So that is like if a company makes a profit, they will be able to divide the profit with you as a shareholder. And then also looking at it from a point of giving you a portfolio for you as an individual. Starting to build your portfolio right now is it's something that would be very important for all of us. Whether you're buying an insurance cover, you're investing in a bond, a money market, or you touching into the stock market, having a portfolio is going to be very important as we grow.
Okay, so and so how do I get to withdraw my money, and is it hard to do?
I think withdrawing your money is very simple from the market. Just the same way investment banks and brokers nowadays have ways at which you can deposit money, whether it's through M-Pesa, whether they're giving it to you through the bank, you do a bank transfer to them. The same way now when you're withdrawing, they would send the money back to you on M-Pesa for transactions that are below 70,000. They will give you money back to your M-Pesa account. And also if it's above that value, then they can send it